Welcome to the Market Mosaic, where every week we are breaking down macroeconomic data, stock market technicals, and market internals, things like breadth, sentiment, and positioning data to try to figure out where the stock market could be headed over the near term. This past week had brought us the first government shutdown in nearly 7 years. And besides the economic impact of the shutdown, it's also delaying the release of key economic data at a time when the Fed is missing the mark on both its mandates, both on the labor market and inflation. We'll talk about that more in just a second. But for the first time since late 2018, federal government is now in a partial shutdown. So Congress failed to agree on a new funding bill for the fiscal year that starts on October 1st. Right now, if you look at odds markets, the current shutdown is expected to extend at least into this week. But here's the thing. Shutdowns are typically non-events for the stock market. This shows the last 6 shutdowns that have happened over the last 35 years, going back to 1990. And you can see the composition of the House and the Senate and the number of days that the shutdown lasted. The last one that started in 2018 was actually the longest shutdown on record at 35 days. But here's what you want to focus on. Even though it's the longest on record, the S&P 500 was up 6% around that period. And if you go back and look at these last 6, you're going to see that the S&P averaged a 1% gain. If you take this data set back further, if you look at all shutdowns since the 1970s, there's been like 22 of them, you will see that the S&P 500 ends pretty flat. It ends with, on average, a gain of like 0.3%. And it's up, about 55% of the time. So really the market just doesn't really do much during the shutdowns, despite everything, all the fear mongering you're going to see in the headlines. But that brings me back to, what I think is going to be the bigger issue with the shutdown is happening at a time when the Fed has just started cutting interest rates because of fear over the labor market. But with the government shut down, we're going to it's going to limit release of some key data points that could influence what the Fed does here. So again, we're not releasing key economic reports. That includes a jobs report that should have been out last Friday, but we still are seeing some reports, private sector reports. So this shows the ADP, their report on private sector payrolls. And here's the thing, it had showed another loss of 32,000 jobs right here during the month compared to expectations. Expectations were for a gain of 45,000. So lost 32,000 versus expected a gain of 45. And this number right here, this was a big revision right here. August got revised to a loss as well. It was previously the initial estimate showing a gain. So, but here's the other thing. We're getting some of this labor market data. It doesn't look the greatest right here, but there's more evidence in other reports coming out that consumer inflation will keep increasing in the months ahead. And that could be exacerbated by one big factor, and that is the historic weakness in the U.S. dollar index. But nonetheless, the markets are going to stay fixated on the shutdown for now. We've got the threat of mass layoffs, or at least the furlough, potential furlough of hundreds of thousands of workers. That'll present additional risks to the economy, and that is locking in forecasts for further rate cuts in the months ahead. So right now, I know October, the Fed's next meeting in October is pretty much a 100% chance of a cut. Odds for more cuts after that are running pretty high as well. But look, I maintain that this has been a slow to hire and slow to fire jobs environment. And I think you could really see the job market start to improve as the fog from the trade war is lifting, because look, we already have the economy running pretty strong right here. Last quarter's GDP was revised to a 3.8% annualized gain. Current quarter estimates also running at the same level. Back-to-back quarters of 3.8% GDP growth is not associated with recession. But you still have rate cuts, you still have loose financial conditions, so those are also ingredients that can add pressure to inflation in the months ahead. But for now, I think this interest rate backdrop and I think investor positioning, that remains a tailwind for this bull market. And so this week, I want to go a little bit further into the growing challenges to the inflation outlook and how the dollar could play a key role in that outlook. I also want to take a look at gold stocks and why the so-called dumb money in the institutional investor space, the dumb money is adding more fuel for this rally. All right, so even though the government shut down, that is delaying the September payrolls report. But as we've seen, other data continues to show weakness in the labor market. That includes the ADP report. And we also had the JOLTS, the job opening and labor turnover survey. That was the most recent labor market related report before the government shut down. That shows that there are now more unemployed workers than job openings. So this concern over the labor market is going to continue taking the spotlight, but inflationary pressures remain a huge issue that could push consumer prices higher in the months ahead. And here's one of them, the ISM Services PMI. So these PMIs, they are looking at overall activity in different sectors of the economy. In this case, we're looking at the service sector. And they ask these questions, they ask a variety of questions to come up with these underlying components. They'll look at things like new orders, employment trends, and so on. But one of the things they'll ask about is the prices paid component. So the prices paid measures the input changes in input prices for services organization, and that's this blue line on here is the prices paid. The most recent update to this chart shows that prices paid running at 69.2, and the most recent ISM report out last week is ticked up just a little bit to 6. So the prices paid running well above that 50 level, showing an expansion in prices paid. And you can see on here, it tends to lead changes in CPI. So the year-over-year change in CPI is this orange line. You can see this inflection higher in recent months. You can see in looking back in the past how this blue line tends to lead several months, sometimes longer before CPI. So you had this peak back in late 2017 before peaking in CPI in 2018. You had a turn higher. That first inflation wave coming out of the pandemic, that turned higher just ahead of CPI. You had prices paid peak and stall out, quite some time before the actual peak in CPI. So this is very important. This bottom here a year ago and turn higher is very important for the inflation outlook here ahead. All right, so currency debasement, that could be another factor into inflation pressures in the months ahead. And that is because the US dollar index is having a historically bad year. Okay, it is down about 10% year to date. It's been down about 10% year to date as of the first half of the year, and it's just been grinding sideways. That marks one of the worst performances to start the year ever, at least since 1973. And that's a significant decline for a currency, especially when it's the world's most important currency. And the impact of that is that a weaker US dollar increases the cost of foreign imports. And while there's a lag effect, you're not going to see this show up right away. There's going to be a lag effect, but those rising prices for imports tends to eventually show up in consumer inflation gauges. And the Fed is aware of this. Their own modeling, they have a model that takes this into account. Their own modeling shows that a 10% decline in the dollar adds about 0.3% to inflation. So that's what this chart on here is showing. The year-over-year change in CPI is this blue line, and this green line is a dollar index, but it's been inverted. So rising actually means the dollar index is falling and vice versa, but they inverted this so you could see how this is pretty correlated to changes in CPI, sometimes leading the way there as well. So another factor to watch that could push inflation higher here in the months ahead. So a weaker dollar, that could spark more inflation, but a falling dollar also tends to boost risk assets. So everything from stocks to commodities, a lot of times you'll see a tailwind from a weaker dollar for various reasons. On the stock side, especially with large caps, so domestic large cap companies, ones that receive a large portion of revenues and earnings from international regions, they can see an earnings bump from a falling dollar. So sales of products and resulting earnings in foreign currency, when the dollar is weakening, that foreign currency can buy you more dollars. So that's that translation impact and how it can boost earnings. Well, commodities, they're also often priced and traded in dollars. And so a weak dollar, it increases the purchasing power of non-US buyers. And so this chart shows the correlation over some recent time frames for various assets to the dollar, where you can see pretty much a negative correlation has been a tailwind from everything from the S&P 500 to gold. So we've got the blue line is the year-to-date correlation, got the last 50 days and the last 20 days. So again, looking at some of the shorter time frames on here, but just given the weakness in the dollar this year, focus on the year-to-date figure. Just look at gold miners, silver, strong negative correlation to the dollar as you would expect. S&P seeing a boost there as well, but overall most of these bars in negative territory, showing that negative correlation for various, again, risk assets especially. precious metals and risk assets, that negative correlation against the dollar. So while this hype and valuations around the AI trade, artificial intelligence, stocks like NVIDIA, the focus there is continuing to run high. But look, precious metals and the related mining stocks have been among 2025's leaders in the market. You've got gold prices up 46% this year. Now, silver has gained 63%, and that's fueling the mining stocks as well. You've got the VanEck, the gold miners ETF, the ticker there is GDX. It's up 127% this year as I'm recording this. And that's because the metal prices, these high metal prices, are boosting the earnings outlook and the outlook for more growth. And so what this chart on here does is it plots an index of gold mining stocks. It's the white line. Against trailing 12 months earnings per share is the blue line. And here's the thing, it indexes this to 100. So it has the same starting point, indexes to 100 back in 2020. And you can see, especially if you focus more recently, earnings growth is significantly outpacing price. So you see, the stat that GDX is up, 127% this year. You're seeing this massive run in gold miners, while collectively across the sector, earnings are rising at an even faster clip than what price is, which is absolutely incredible. It means valuation ratios like the PE ratio are actually shrinking as price is doing this, because earnings, again, are expanding quicker than price appreciation. So that's just something to keep an eye on with the gold miners right here, is watch that earnings outlook, because that can fuel more price appreciation despite the fact that they've already had a big run. We could still be in the early stages there. Across the market, continuing to climb a wall of worry. So despite concerns over the health of the labor market, the fears over the economic impact of the government shutdown, the S&P 500 is still hovering near record highs. It has spent 108 consecutive days trading above the 50-day moving average. But investors collectively have been slow to add equity exposure. No matter where you look, various measures of sentiment, investor sentiment, and positioning data are running pretty neutral. That could be surveys asking if investors are bullish or bearish. That could be positioning data, looking at how investors are actually allocating their money. And overall, these things are pretty neutral, which is surprising, because you would expect bullishness with the market doing what it has done. You would expect bullishness to be running high and maybe near extremes, but in some cases, it's actually the opposite. So the chart on here, we're looking at S&P 500 stock index futures positioning, and this shows a relatively large net short position as a percent of open interest, a net short position by large speculators, so also called the non-commercials. These large speculators, when you're looking at the futures positioning data, are considered to be the dumb money in this data set. And you can see they are pushing short bets against the S&P 500 to levels that you've seen during major lows. So this was a low heading into, there's a sell-off into around April in 2024 into 2023. This is after the bank crisis earlier in the year. Here's the short positioning during near the lows of the 2022 bear market. Here after the pandemic set in. So again, you don't tend to see this type of positioning when the market is at an all-time high. But again, if large speculators move to unwind this position, that is just more fuel for the rally. And again, just shows you that the market is climbing a wall of worry right here. All right, looking at data coming up in the week ahead, overall it's a fairly light week. It depends on what happens with the government shutdown, but we still have some very important events to keep an eye on. A couple of them are with the Fed. We'll get the minutes of the Fed's last meeting. And so the meeting before this one, the concern had shifted to inflation, and then Powell set the table for a shift back to the labor market at Jackson Hole. Well, in recent comments and a speech he gave the other week, he talked about there's no risk-free path. So they're really clouding the outlook for what's more important right here, labor market or inflation. So maybe the minutes will shed some light on that. But then you also have Fed Chair Powell himself speaking on Thursday next week. So keep a close eye on that speech and comments that he makes to indicate where the Fed is seeing the bigger risks, because that will influence the outlook for rate cuts. And if we do get some resolution of the government shutdown, I don't know what this will look like, but there's a possibility that we'll get the September jobs report. This again, depending on the timing of the government shutdown and if we can get a resolution there. All right, a couple trade charts to keep an eye on this week for trades. One is with symbolic ticker SYM. I zoomed in on this chart. If you were to take this back, you would see that this 65-ish level is a very significant resistance level from a couple years ago. So we came back to that level in August, mid-August, touched it, had a pullback, rally back to it, smaller pullback. That pullback, this is why I like to see with these setups. You get this MACD reset at the zero line. This is a bullish momentum reset. You can kind of see the same thing happen back here. You get this bullish momentum reset at the zero line, and that helps build momentum support for a breakout. So that's what we're going to watch for right here. We want to see if SYM can get over this $65 level. This is a stock that operates in the robotics and automation space. There's a lot of bullishness around that market theme right now, so keep a close eye on SYM. Another chart to keep on your radar in the week ahead as well is going to be with commodities. Commodities, we've shared this chart recently, but they are really trading tight here at the high end of a range they've been in, a bullish pattern that's been setting up going all the way back to August of 2022. So you've got this resistance around the 20, just below the 24 level that's been touched a number of times. You've gotten higher lows along the way. This ends up being a massive ascending triangle consolidation pattern. It tends to resolve in the direction preceding the pattern, which coming into it was this big uptrend into 2022. So I think, again, a lot of the hype right now is on AI names, or quantum computing's been in the headlines a lot here recently, or what's going on in the renewable space. Well, I think commodities, as gold has shown us, as silver has shown us, commodities in general, I think, is a sleeper trade kind of heading into next year, meaning there's not a lot of focus and attention on this. And if you get this breakout, it's going to go by largely unnoticed. But I think this could be a very, very significant trade, especially as we head into next year, if we get it cleared above that resistance level. That bullish energy, the bullish pressure for a breakout has been building for years now. All right,